I know this might sound a little crazy, but high interest rates can actually be good for the housing market. And I want to explain this a little bit and go over how high interest rates actually helped baby boomers buy property back in the 80s when interest rates were 18%, because interest rates were far higher back then than they are today. But yet a lot of people are upset that the interest rates are high, and it feels like a punishment that people that want to go out and buy a home right now have to pay a lot more in interest, which basically makes the home unaffordable that was affordable just a couple of years ago. So the first thing is, when we have these high interest rates, the first thing that it does is it takes a lot of people out of the market, which obviously those are the people I'm talking about. You know, you're saying that it's not good, you know, you're not happy, you're being pushed out of the market, and I realize that's unfortunate. But for the people who still are going to be in the market to buy a home, this is good news, because less competition means you don't have to be in multiple offer situations, overbidding on the property, and you can go back to getting seller concessions, actually doing inspections once again, as well as maybe even getting the property below list price. Who would have thought? But you know, an interesting dynamic that happened back in the 1980s when baby boomers were buying homes was that even though interest rates were at 18%, this actually helped them buy homes. And you might think, how is that possible? Like, you know, in what world does high interest rates help someone buy a home? Well, I'm glad you asked. Because we had such high interest rates back then, baby boomers were able to save their money in a high interest savings account. And when you're able to get a 10 or 12% interest rate on your savings account and then go ahead and stack money in there every single month, that can compound your down payment for the home quite nicely, making it very easy to save for the down payment, versus in a low interest rate environment, your money is not working for you unless you're investing it in the market. And even then, if you've been investing in the stock market over the past year, essentially, you could be down by quite a lot right now. So back then, putting the money in just a simple savings account was enough to help save for a down payment on a home. And even though the interest rate that they paid on the property was a lot higher, it still helped them save for that down payment. And now we're in a sort of similar situation today. It's not nearly as favorable as it was back in the 1980s. Like, I have a Discover high interest savings account, and it's one of my favorite online banks. And right now they're paying like 3% interest for the year. You know, and before, when interest rates were rock bottom, it dropped down to like 0.5%. So it was practically nothing for a while, and that was supposed to be a high interest savings account, you know. Fast forward to today, the interest rate is up to 3%, which isn't too bad coming from 0.5%. Now, I know we're still not beating inflation with the 3%, but it's better than nothing. When everything costs a fortune and inflation is up, every little bit helps. The other really great thing that's gonna help people in the long run having these high interest rates is the fact that high interest rates to borrow in the long run leads to lower home prices. Because just like we said in the beginning, less people can afford to buy. And as there's just less buyers out there in the market, and as we go deeper into the recession going into 2023, there's just going to be less people out there looking to buy because they're not in the financial shape to do so, and the higher interest rates have made it less affordable. And I think we're going to see this dynamic at play once again, just like back in the 1980s, where the home prices have gotten too high and it's basically unaffordable for most people, and it's going to drive the prices down. And if the interest rates remain elevated like the Fed is saying they're going to throughout 2023, it will keep housing prices in check, because people can't ask more for the house than what people can actually afford to pay, unless you're in a crazy environment like here in Miami where half the home sales are cash. But if that's not the case where you live, then that's probably not something to worry about, and it's actually going to help your local housing market. I stopped over here because it's like this huge mansion that's like all boarded up and abandoned here. Looks like no one probably lives here. Strange. And you can still rent a house next door for the low price of only $18,000 a month. We walked by this house probably a month or two ago whenever it first listed for rent. Now it's been almost 2 months on the market for rent. Still $18,000 a month, no price drops. And you know, these people are losing $18,000 a month, or even if it's only worth $10,000 a month as a rental, these guys have already lost 20 grand keeping this place vacant. I will never understand this tactic as a landlord. I don't care if it saves you money on taxes or not, you're still losing money. Even though these high interest rates are probably going to benefit home buyers over the next few years in the long run, the problem is it puts a lot of short-term pain onto folks and into the economy. And I feel pretty bad for, you know, elderly people that are getting affected by this right now. I saw a report today out of Boise, Idaho, where a lot of the elderly population there are becoming homeless because the rent prices there have absolutely skyrocketed. It went from like $1,200 to $1,800, and you know, people that are living there on a fixed income just can't afford it. And I'm sure it's not just in Boise. I'm sure this is happening all over the place, but that's where this report came from. It's pretty sad when people that, you know, already paid their dues and worked for a lifetime can't afford a place to live anymore. And the thing is, no one really saw this coming. Nobody knew that everything was going to shoot up in price as massively as it did. I think that's been a shocker to everyone, and unfortunately everyone's starting to pay for it now. Now, it's been a little while since we've talked about layoffs, and sure enough, we have another announcement this week of another company doing layoffs, and the most recent one, which is a big one, is Pepsi. Pepsi this week announced that they're going to be laying people off, and we don't even know by how many people yet. And the funny thing is that Pepsi's earnings are up. So Pepsi apparently hasn't been struggling that much, and they've been thriving pretty good during a relatively tough economy, which really isn't a surprise considering they basically just sell junk food, you know, soda and chips and stuff like that people probably shouldn't eat, but they do anyways. But for a company that has revenue up 9% year over year, which is a stark contrast from a lot of companies that have been hemorrhaging money over the past year, they're still going to be doing layoffs. So to me, what that says about the overall picture of the health of the economy is that things are in trouble, guys. When you have companies like Pepsi announcing that they're going to be doing layoffs, and even though they're doing well, these guys are bunkering down for the recession. That's exactly what they're doing. When you see layoffs like this, you can pretty much interpret it as a sign that we are headed towards a steep economic downturn right now. And when you have companies that are doing well financially, still looking to cut their expenses even further, they're basically gearing up for the worst. You know, just like we talk about here all the time on the channel, they're preparing for the worst and hoping for the best. But the downside is people are going to lose their jobs from this. And here's what the memo from Pepsi says about this. They say they're doing this to simplify the organization so we can operate more efficiently. And they also said that the layoffs are going to happen in their beverage division, as their snacks division had a bunch of people that took voluntary retirement, so they don't really need to do the layoffs in the snack division. This is going to apply to the beverage division of the company. So if you work for Pepsi and you're in the beverage division, keep on the lookout for this. And it's not just Pepsi either, guys. In fact, today, Goldman Sachs announced that they are very likely to lay off 8% of their workforce in the coming months, and that's about 4,000 people. And for a company that only has 49,000 employees, you know, to lay off 4,000 people is significant, you know? So in case you haven't picked up on the trend yet, a lot of companies are gearing up for this recession because that's how the companies are going to survive it. And I just don't understand when people say there's no recession or it's not going to be so bad, because even successful companies are laying people off now, guys. I mean, that's where we're at with this, and you're telling me that's not a recession? I mean, I don't even remember the last time I heard about a successful company laying people off, like Pepsi, for example. Goldman Sachs has made some investments in technology and banking, and it hasn't worked out so well for them. They haven't hit their profitability targets. And on top of that, they're going to be cutting out bonuses this year because compensation and payroll is literally the company's #1 expense. So this is how they can save money, laying people off and not giving you a bonus anymore. So this is the shape of things to come. This is where we're at with it. And it seems like every week we turn around and we hear about new companies doing layoffs. And these are just the two that I read about today. I saw another article talking about other companies, but I didn't want to spend too much time on the layoff stories in this video. But it just goes to show you guys that every time we turn around, there's announcements of layoffs. And this is what the Fed wants. So let's remember that too, because the Fed wants unemployment to go up. So to the Fed, this is good news. But to the average everyday person who needs a job, needs to be able to pay their bills, not good news. In fact, everybody thought after the Fed did this 0.5 point rate hike that the markets would celebrate and everything would be beautiful. But instead, it was actually quite a different tune, because right after the Fed interest rate hike, the S&P 500 lost 2.5%, which is about 100 points, and that's the worst day they had since November. And it seems like, oh, no surprise, Wall Street underestimated just how far the Fed is willing to take things to curb inflation, because they thought that, oh, this is going to signal a Fed pivot. I don't know if you guys remember, but a couple weeks ago, I made a video talking about a Fed pivot, because that's what everybody was calling this when they were going to switch to 0.5 point rate hikes instead of 75 basis points. It's not a pivot, guys. But a lot of people interpret it as that, including a lot of stock market bulls that just think things are going to go up forever. And it turns out that's not the case. So if you think your stock market portfolio is suffering right now, just wait till next year, guys, because next year the Fed is planning on raising their rates to 5.1%. And as of right now, they're only at 5.25%. So there are more rate hikes to come from this, and as they keep raising the rates, all of these companies are going to continue losing value, and the stock market is going to be in the toilet into 2023. And like we've been talking about, this is going to affect home prices as well. This is an entire ripple effect throughout the entire economy. Share prices going down, people losing their wealth in their 401ks and their stock market accounts. You have people losing their jobs through layoffs that can't afford to pay the bills. That's going to decrease consumer spending. That also makes it more likely for people to default on their home equity line of credit, their mortgage payment, whatever they have, which is going to increase the amount of foreclosures and short sales that we have. I'm not saying there's going to be a huge wave of foreclosures coming from this. There could be, but we don't know yet, guys. It's still too soon to tell just how bad this is going to get. And that's one thing I'm trying to just stress right now. A lot of people look at the current state of things and think, well, this is as bad as it's going to get. You know, we're already in recovery mode. No, we're not, because of two things that are really important. And that is that, number one, the Fed is not finished with the rate hikes yet. So they are going to continue the rate hikes. And there is a possibility that they may need to go above the 5.1% target that they're talking about. And like we've talked about here on the channel, a lot of people think they're going to have to go at least above the rate of inflation. So say their CPI numbers come down and the next report says it's at 6%. And maybe it hovers at 6%. Maybe it doesn't go down from there. So maybe they have to raise the rates to 6% instead. So imagine what that's going to do to things. And this is not just a problem here in the US, guys. This is happening in Europe. Europe's central bank did the same thing, did the 0.5 point rate increase. It did the same thing in England. And Canada's doing the same thing. Like, this is happening all over the place. So this is not going to be, you know, a recession or a downturn that's going to be exclusive to the US. It's not going to be like that. And all the company CEOs are freaking out about this right now. Even Elon Musk is like basically begging the Fed to start bringing interest rates down, because they know that this is going to cause a lot of economic pain. And the other thing is, everything is delayed with this. When you have these interest rate hikes, the effects from it are not immediately felt. It takes time for these rate hikes to have its full effect on the economy. So We've already seen home prices start falling since the middle of the year. We've already seen the stock market been falling since the beginning of the year. So we can pretty much just say that into next year, into 2023, guys, you're going to see more of the same. It's going to be more of everything just going down. It's not like all of a sudden it's going to turn around. My thing is, we have so many clear economic indicators that this is what's going to happen. Why would you deny it and not pay attention instead of just get ready for it and be putting yourself into the best financial position to be able to take advantage of these things? Just like I talked about in the video, the pros and cons of the coming economic collapse. And I know the economic collapse is kind of a outlandish term to call it, but you gotta write these things, otherwise people don't respond. It is an economic collapse when you look at how good and how strong things were for such a long time. So from that point of view, it is an economic collapse. It doesn't mean we're all going back to living in dirt shacks, but it does mean that the quality of life and the standard of living for people is going to go down temporarily until this whole mess gets sorted out. And another interesting thing that I read about this today was that even though home prices are going to start coming down and rents are starting to fall in some areas as well, this is not going to be enough to tame inflation, guys. In fact, what this does is it can actually make inflation worse in other sectors, because even though inflation might come down in the housing sector because of affordability issues, the other problem that happens is that because people can't afford the new house anymore, but they still got some money saved for it, they might end up blowing that money on something else, which would be very foolish right now, but people will do it. You can pretty much guarantee they're going to do it. All you got to do is look at how much the credit card debt's climbing, and supposedly the best Black Friday ever, and all of this to show that people are still going to buy and spend money on things whether they have it or not, and whether it's a smart idea or not. And so the idea behind this is that even though home prices might come down, the interest rates are going to keep affordability low. So it's still going to be very expensive to buy a property, and therefore people that have any extra money or just have given up on the idea of buying a home, maybe they'll go out and buy that new TV. Or maybe they'll go out and buy a car instead. Or maybe they'll go on a shopping spree and go out and spend a couple $1,000 on new clothes. Who knows what they're going to do? But the point I want everybody to understand from this is just because we see home prices going down is not going to automatically mean that inflation is now cured. It's not going to be that simple because of the effect that this has on the overall economy. When people can't afford one thing, they end up buying another thing. That's kind of the thing that we're looking at here. And it basically just comes down to when people have money in their pocket, it starts burning a hole in it and they have to spend it on something. So that's why I think going into 2023, we're just going to see things get even worse than they are now when it comes to the stock market, the housing market. But it's not all bad, guys. Prices coming down on things are good news. Stock prices coming down, good news if you want to buy in. Home prices coming down, good news if you want to buy in. All this is good news if you flip it on its head and look at the positives from it. But if you dwell on the negatives and say, oh, everything is down and I can't do anything now because I lost my job and I'm not willing to look for another one, then you are going to suffer from this. But I would rather be prepared and look for the opportunities coming and be ready to seize them, because that's exactly what I'm doing, and I'm trying to inspire hope and give you guys who watch the same hope and inspiration to do the same. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I put out a new video. If you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.